Welcome, everyone. My name is Nikki Johnston. I'm with Transition Advisors. Our webinar today is Preparing Your Firm for an Upstream Merger. Before we begin, we have a few important items to cover. First, please go ahead and close any other programs that you have running on your computer. This will just help to ensure a quality presentation and reduce any audio issues. Transition Advisors LLC is a proud and approved sponsor on the National Registry of CPA Sponsors per NASBA. In order for you to receive the 1 CPE credit for today's webinar, you must complete the 2 requirements. The first is that you participate in 3 out of the 4 polling questions. And please note that GoToWebinar does monitor your participation in these polls. Next, you'll also need to complete an online evaluation that will appear in your screen immediately at the end of the webinar. So please take a moment to complete that before you close your browser. Once you've met both of those requirements, I will email your CPE certificate within 10 business days. Now, in order to fully participate in the webinar, please take just a moment to familiarize yourself with the GoToWebinar control panel. You should see it on the right-hand side of your screen. There's an orange arrow near the top that you can use to minimize that control panel. During the presentation, all the participants are muted, but if you'd like to communicate with us, any questions that you might have, you can just type those into the box and click send. We'll do our best to answer those throughout the presentation. If we don't get to them, then Terry will respond to everyone by email. Finally, I'd just like to remind you that Transition Advisors offers 2 free 1-hour CPE webinars each month. We have some upcoming topics including alternative deal structures, preparing your firm to grow through M&A, and a session about how to admit new partners. You can find a complete list of all of those webinars, including links to register for them, on the CPE courses section of transitionadvisors.com. Now, I'd like to remind everyone that you did receive a link to the presentation in that reminder email sent out from GoToWebinar. I've also just sent the same link in the chat function, so you can click on that there. If you'd like to receive a PDF as an attachment, you can just reply to one of those reminder emails. That'll go to me, and I'd be happy to send it to you. Now I'd like to introduce our presenter for today's session. Terry Putney is the CEO of Transition Advisors. Thank you so much, and enjoy the webinar.
Thanks, Nikki, and remind you, if you have any questions during at any point during this webinar, please submit those in the chat box. I'm happy to answer them either during the presentation or at the end. And if perchance we're unable to get to your question, we will respond to all questions by email. And also feel free, if you have a specific question you want to just direct to me, you can do that through email as well after the presentation. Transition Advisors is a national consulting firm. We work only with CPA firms and only on issues related to ownership transition. That falls into 2 general categories. One is mergers and acquisitions. We help arrange, structure, negotiate, document, and assist in every way with mergers and acquisitions, including finding the parties, a party that you might want to merge into or have merge into you. And the other big area that we work on is owner agreements and internal succession. So if either of those are of interest to you, we'd be happy to talk to you about how we can assist you. We're going to start off with a polling question so that I can get some idea of the nature of the audience today.
Okay, the first polling question is up there on your screen. It's how many equity partners do you have in your firm? We'll give everyone just a couple more seconds to answer this one. Pretty straightforward. Okay, I'll go ahead and close the poll. The results are there on the screen. 45% of the folks on the call have 1 equity partner. 35% are in the 2 to 4 range. 15% 5 to 9, and then 5% in that 10 to 19.
Okay, thank you, Nikki. There's a very good chance, based on the level of activity in the profession right now around mergers and acquisitions, that you either have been approached by a firm recently or are thinking about something related to mergers and acquisitions. And probably if you're on this call, it certainly applies to everyone on this call. But almost every firm is going through something related to mergers and acquisitions in the profession, and it's driven primarily, a lot of it is driven by succession issues related to the demographics of the profession as the baby boomers who tend to still own a majority of the firms in the CPA profession age and reach retirement, this becomes an increasingly popular approach to dealing with succession issues. We're going to, throughout this webinar, we're going to use a case study. This represents a firm that we actually worked with in a recent deal. Use a case study as an example of how to address many of the issues related to an upstream merger. This is a firm that ended up merging upstream into a firm that was somewhat larger than them. This firm, the selling firm or merging firm, was 3 partners, about $2.4 million in fees. The capital that they had in the firm was about $800,000. That means, primarily the receivables and WIP and other assets, but in most firms that makes up the majority of the hard assets. The firm's 3 partners were Frank, Alice, and Dan. Frank was 63 years old at the time this transaction happened. He owned 70% of the equity and managed over half the business. His comp was somewhat reflective of the amount of business that he was managing at $450,000. Frank was close to retiring, and that's what primarily was driving the need for this merger. Alice, the second senior partner, was only 55 years old and really had no idea of when she wanted to retire. I mean, usually people at this age group are normally thinking 10 years out. Usually 65 is the most popular answer I get when I ask that question. And that's how Alice answered the question as well. She owned 25% of the equity. She managed about 1/3 of the business and had a comp of around $275,000. Dan had been recently admitted as a partner. And quite frankly, the idea was that Dan was going to take over for Frank and help with the succession, but things weren't really progressing as fast as they needed to. But Dan had about 5% of the equity, managed about $300,000 of fees, and was making about $150,000 at the time. The underlying situation here was they had a buy-sell agreement. The buy-sell agreement required that the capital, the $800,000, or the portion of capital that pertained to any retiring partner, would be paid at the end of the first year. The goodwill value, the intangible value, was to be paid over 5 years at 1x revenues plus 6% interest on the total revenue times equity. So, in the case of Frank, who owns 70% of the firm, that would be pertaining to his 70% of the revenue. Alice and Dan, and by the way, those terms are somewhat aggressive, very difficult to deal with internally. I've done other webinars, and in fact I did one just a week ago on this very issue. So if you're interested in how your agreement might work in a buyout of a retiring partner, or if you're interested in putting together an agreement, I suggest that you refer back to the webinar I did last week, or other ones that we've done, and you can find those on our website. Alice and Dan believed that they couldn't afford the payments to Frank. They didn't have the talent on the bench to replace Frank. It turns out that Dan wasn't strong enough yet to do that, and they really felt like the payments were going to be too onerous. They weren't going to be able to afford them. And they certainly didn't feel like they could manage the firm and the clients on their own. They just didn't feel strong enough to do that. So they were interested in finding an alternative solution. The typical things that reasons why firms pursue upstream mergers are listed here. It's important that you identify why you would want to entertain an upstream merger. The reason for that, of course, is you want to make sure that you're talking to the right firm about the right kind of deal so that you can accomplish your goals. But if you're in a multi-partner firm, as many of you are on this call, you're going to have differing objectives and differing goals within your partner group. So especially if you have a wide variety of ages. I used to be the managing partner, and this goes back quite a long time, of an 8-partner firm that we ended up selling during the days when firms were consolidating in the late 90s. And within that group of 8, there were probably at least 3 separate reasons why our partners wanted to retire or wanted to sell. 3 of those were interested in succession issues, but some of those of us that were younger had no real concern about that for ourselves. We certainly did with respect to how we were going to deal with the older partners. But we were looking more for a career opportunity, for what the upside was, felt like our firm was kind of stagnant and maybe wasn't going to provide us the future that we were looking for. So it's important that as you address this, as you attack the possibility of an upstream merger, that each of your partners and you know why each of you are pursuing this potentially. And the reasons why, of course, are listed here. Succession is always the big one. I'd say 90% of the deals we're involved in are driven, at least to some extent, by succession issues. But also, in an effort to kind of grow and create a better professional opportunity, you might be trying to expand the reach of your special services that you offer, eliminate undesirable tasks and situations. As a small business owner, you're always being asked to do things that you'd rather not do or not well suited to. Reduce the overall risk of the firm, increase potential for your professional and financial growth. In the area of risk avoidance, as a younger partner in a firm, you may feel like the liability to your former and soon-to-retire partners as two owners, you can't really deal with it. You may feel like some of the specialized services that you offer are unsustainable. It may be because you can't find a successor within the firm to take over for someone who has a specialized service that they're offering. An example of that is a firm I worked with that had a partner who was involved in doing IT consulting for a specific industry, the nursing home industry, and they didn't have anybody in the firm that they felt like could take over for that partner. He was managing roughly $1 million worth of business, and if something happened to him, that would create not only a loss of probably most of that business, but also impact the rest of their nursing home business in the firm. So that firm ended up actually merging Upstream once they realized that that specialized service was probably unsustainable in their current form. Lease renewals can create a reason to pursue an upstream merger. I mean, usually you're signing a lease for 5 or more years, and maybe it's time to say, do we really want to do that now based on the uncertain future? The potential loss of key employees and loss of key clients, of course, can also create a reason to merge. Going back to our case study, the firm that approached Frank and Alice and Dan was a 6-partner firm with about $7 million in fees. This is not an unusual relationship in terms of size with mergers that we're involved in, especially with these size firms. Typically, you're going to be talking to a firm that's probably at least 2 times up to, you never know how much larger. Obviously, you could be talking to a firm with multi-$100 million in volume, but usually it's usually 3 to 4 or 5 times your size is the firms that tend to fit culturally and tend to fit in terms of capacity, being able to actually carry off the merger. In this acquiring firm, there were 2 partners that would be retiring in the next 4 to 6 years, respectively. We'll address what that means to this situation later. There were 4 partners waiting on the bench in this firm to become, or 4 partners in waiting, meaning probably senior managers in this firm that they saw were looking for an opportunity to promote. And the firm knows that it needs to promote partner candidates, but is concerned about polluting or diluting its profit pool. So in other words, rather than cutting the same size pie up into more pieces in order to create new partners, it would be better if the firm could grow the size of the pie and make the pieces, even make them bigger, if not at least make them the same. So that was one of the driving reasons why they wanted to pursue growth through mergers. Normally firms that are attacking growth by merging in other firms are doing it for one of these reasons. And why is that important for you if you're pursuing an upstream merger? It's really important that you understand what the strategic goals are of anybody that you're talking to, because it could be that their strategic goals are going to lead to a conflict with your goals. It could be that what they're trying to do isn't going to be satisfied with your firm, or they're going to do it, or they're going to do the merger in such a way that isn't going to work for you. So it's important that you find out succinctly what it is they're trying to accomplish. And these are some of the reasons why firms tend to approach growth through mergers and acquisitions. Sometimes just a pure growth in billings. The firm just doesn't feel like it's large enough. It isn't offering enough opportunity for profitability and for its partners, and it maybe needs to be a stronger brand in the markets that they're operating in. We see nowadays more targeted mergers that are looking for specific talent and services, either to expand a service area they already offer or offer a new service area. Certainly geographic expansion for larger firms is important as firms fill in the map and identify the market that they want to serve and how they want to be represented in that market and find holes in the map. That's going on at the national level with many of the top 25 firms. You know, brand enhancement, larger typically means stronger brands. That's often a driving force. Of course, acquiring clients to cross-sell existing specialized services to, and in some cases strengthening the succession team for the firm that's doing the merger. And in the case of this acquiring firm in this case study, that was one of the reasons. Most deals fall into 4 categories of structure. The first 3 would be considered a sale, and the 4th, of course, is a merger. And we're going to talk about the difference between sales and mergers and how to structure, different ways to structure sales here in just a minute. With that, I'm going to turn it back to Nikki for a polling question.
Okay, thanks, Terry. The second polling question is on your screen here. What issues do you see affecting your practice most next year? Got 5 different options this time: succession for retiring partners, admitting new partners, client retention for retiring partners, and need for growth, or you can choose all of the above. And this is our second of 4 polling questions. As a reminder, you will need to complete 3 of them in order to get your CPE credit today. Okay, just a couple more seconds and then I'll close the poll. And the results are now on the screen. Half of respondents said need for growth. The next most popular response was all of the above at about a quarter of the folks on the call. And then 18% said succession for retiring partners and the other 9% client retention. And no one selected admitting new partners.
Okay, very good. You know, the first thing we're going to delve into is what is an outright sale. You know, when people think about selling their practice, they envision pretty much an outright sale. I think they think of it in terms of what does a sale look like. Buyers do the same, by the way. And if you know, it's sort of almost like selling a house. You list it, you show it, you sell it, you get paid. And certainly there are a lot of deals that are done this way, and we get involved in some of those. The complication, the problem is related to a proper transition of the practice. Your practice is made up of relationships. There's nothing you can do to make a client stay with a successor firm. All you can do is help the client make that decision to do that. And if you're unable to successfully make a transition of your client relationships to the successor, then obviously the value of the firm is going to be affected. You know, as a seller, you're going to maximize the value by actively participating in the transition. The longer you're doing that, the better. The better probability you have for success. How much you should be willing to do, however, without getting paid any additional dollars, or by getting paid at a much lower rate, becomes an issue. So, for instance, if you were willing to stay on full time and do exactly what you're doing now, and gradually over time make the transition, that's a very powerful transition plan. But you know, how long are you willing to do that without getting paid? On the other hand, the buyer's return on investment is going to come from the profits that you used to take out as compensation. So if they're paying you for the practice and at the same time you're working, they're likely going to want to keep your profits in order to create that return on investment. So what often happens in the situation where we have the buyer and the seller who are kind of conflict with respect to how to do this transition, what we end up doing is shortchanging the transition because both parties are trying to get what they want monetarily. So the seller ends up working much less, becoming much less involved in the transition in order for the buyer to get a return on investment on the payments that the buyer's making. And the result, unfortunately, in some cases, leads to much lower value due to retention adjustments. So one of the pitfalls of an outright sale is oftentimes a poor transition. You see, listings for practices for sale. That's in fact what's being anticipated. A better approach to this is what we call a two-stage deal. We've written many articles for the Journal of Accountancy. You can download those articles on our website, by the way, on how to structure two-stage deals, what the benefits are of them, and so forth. But generally, if you can give yourself at least 2 years up to 5 years in advance of when you want to slow down, when you want to leave the practice, then a two-stage deal is going to work a lot better. Stage one in a two-stage deal is the transition period, the working period. Typically, the seller merges into the buyer's firm. It looks just like a merger to the outside world. Contractually, it's treated more like a sale, but in terms of operationally, it's exactly like a merger. And the seller starts that transition process during stage one while continuing to work full-time in the practice, or if at a reduced rate, not very much of a reduced rate. Seller maintain reasonable control over the clients. Basically looks like a partner in the new firm as far as the clients are concerned. Oftentimes the title might be as a principal or non-equity partner because you're not signing on to the owner agreement for the successor firm. And the most important thing economically is that you maintain your compensation level. So if you're going to keep working full-time, doing the same thing you did before the transaction, you should continue to get paid what you were getting paid. The second stage, though, is when the practice is paid for. So envision, again, let's say we've got a 2-year stage one. The payments aren't going to start until the end of the second year. The seller transitions at that point to a part-time or retired role altogether. Oftentimes it is a part-time role. If they're working, they're not going to be paid at the same rate that they would be as they were when they were paid as a full-time partner in the firm, more likely at a per diem rate, say for instance 33 to 35% of their billable time. And now the purchases payments are going to start, but they're based on a practice that has already transitioned. So the risk that you typically run into with transition has really already been mitigated through those first 2 years because the clients have now assimilated and become introduced to and have already affirmed the fact that they're going to be part of this larger firm. We're going to delve into more of the details of a two-stage deal by using the case study in just a few minutes. So we'll get back into this. A third technique that we see used in particularly in special situations is what we call a cull-out sale, where you'll be selling off a part of the practice or retaining a part of the practice. You can define the parts as being clients, services, or locations. Let me give you an example of a cull-out sale that we were involved in. We had a firm that had 2 offices. There was 7 partners in the Midwest. One of the offices was in a smaller community and was run by one of the partners, and that partner was about 5 years away from wanting to retire. The problem was the firm didn't have anybody that wanted to move down to that market to run that office and didn't feel like they could successfully recruit anybody. So they, in essence, sold off that office with that partner to somebody who was already in that market who could then take over for the succession issues that are required. Another example that we run into frequently is practitioners that have, in addition to an accounting practice, might have a wealth management practice, and they'd like to sell off the accounting practice, keep the wealth management practice because that's typically doesn't require a lot of time and can be done without, even if you're not in the office that you're in now, you don't have, oftentimes need to spend a lot of time face-to-face with clients. And so we're seeing increasingly situations where we're selling off the accounting firm and the practitioners maintaining the wealth management practice. You know, the key difference in a merger versus a sale is the contractual relationship that the, quote, selling partners have with the successor firm. In a merger, you're going to sign on to the owner agreement of the firm that's the successor firm. You're going to become an equity partner or a shareholder in that firm. And you're not typically going to be paid for the value of your practice. You're not going to sell your practice to that firm. You're going to merge it in. You're going to in essence exchange your share of the ownership in your firm for an ownership interest in the new firm. Now there are mergers that are sometimes papered that way, where they look like sales, but in fact it's just still an exchange where we're receiving some kind of value back for some kind of value, the value that's being placed on the practice that's merging in. But in essence, it's really the key issue is what is your legal and contractual role with the firm that you're merging into, and if it's as an equity partner, then we're dealing with it as a merger. We'll get into some of the typical issues related to structuring those kind of deals using the case study here in a minute. So going back to the case study, let's talk about Frank. Remember, Frank was the senior partner, 63 years old. He was about 3 years away from wanting to retire. And his deal in this particular transaction was structured as a two-stage deal. So he had a separate deal from Alice and Dan. In fact, each of the three of them had separate deals with the successor firm. Alice was going to be admitted as an equity partner and was going to be, in essence, a merger. And Dan, as it turns out, because of the fact that he had low equity, you recall he only had 5% equity, and had a small book of business, $300,000. Didn't really have enough to offer monetarily, financially, to successor firm to become an equity partner. So Dan was brought in as an income partner in this particular case, might otherwise be referred to as a non-equity partner with a potential path to equity down the road. One thing that might have accelerated Dan's ability to become an equity partner would be if he became the internal successor for Frank's book of business. And that's oftentimes the case. So once we get into Frank's buyout and Dan demonstrates his ability to take over and manage a good portion of Frank's clients, that could lead to Dan being, at that point, promoted to equity partner. So the parties, when they put this thing together, one of the things we had to deal with was, well, if we're going to deal with three separate entities or three separate deals, how do we divide up, the practice? And it turns out that in this particular case, and probably one of the reasons why they were unable to deal with their issues internally, was they each had distinct books of business. And so we were able, that was an advantage in actually structuring the deal, because Frank's buyout then could be tied to his book of business, and Alice's equity could be tied to her book of business, and so forth. So Frank's two-stage deal looked like this. Stage one was set to contractually end at the end of 3 years. Now, if something happened to Frank earlier than that, either voluntarily or involuntarily, we could terminate stage one earlier, but it wouldn't end any later than 3 years out. His compensation during that time was tied to a percentage of the collections from the book of business that he was managing, and in this case that was 35%. If he used more labor than he historically used to manage that book of business, then his compensation would be adjusted accordingly. So that would allow him, if he wanted to slow down and exchange, fewer hours of his time for more hours of staff time, and it would affect his compensation, but also give him flexibility. So Frank's primary objectives in stage one are smoothly transition his clients to the new firm, maintain the client relationships and the fees so that he can maintain the value, gradually introduce the clients to the successor in their new firm, could be Dan, could have been somebody else, make the day that he retires into a non-event for the clients, eliminating most of the risk of transition, so that once the payments kick in and they become contingent, we're not really worried about that because the clients have already basically said they're going to stay. This is all while maintaining his current level of income. And then within the firm, Dan and other partners in the firm would probably become his successor. During stage two, Frank retained his accounts receivable and work in process at the beginning of stage one in this particular deal. We're oftentimes seeing now in these deals a different kind of arrangement with respect to receivables and WIP because of the investment that's required of the buyer. But certainly the value is going to be retained. It's just a matter of when the seller can realize that value. Will it be at the beginning of the transaction, or will it be delayed? Frank would be paid in this case based on the collections from his clients over 6 years, starting in stage two. So keep in mind now, we're not going to be trying to pay Frank for his book of business at the same time we're paying him full-time compensation. That's the key issue here. It replicates the kind of deal that he would have received had he had been a sole proprietor and sold his practice on the street in a two-stage deal. And Frank would be paid separately for any new clients he helped generate during stage 1 and stage 2 through a new business bonus. So rather than the new clients going into the purchase price, the new clients would be paid for in a separate commission type arrangement. I'm going to take a break here with another polling question. Nikki, I'll turn it back to you.
Okay, the third polling question is on the screen. This one is, which best describes your personal situation over the next 5 years? This time your options include reduce your role and time in the practice, or you might have a partner reducing their role, acquire another firm, or you can select none of the above. Again, this is our third polling question today. We'll have one more, and you need to complete 3 out of the 4 in order to get the CPE credit. Okay, looks like that's nearly everyone. I'll go ahead and close the poll and share the results. Nearly half say that they'll be reducing their role and time in the practice. About a third say they'll acquire another firm, and then the remaining 18%, none of the above.
Okay. You know, think about what creates value in your practice or value in a seller's practice. And what is the value of the practice based on? You know, one of the things that I oftentimes hear from sellers, particularly small sellers, who are concerned about retention, the retention adjustment or retention feature in many acquisitions, and almost every acquisition that's a sale, is going to have retention adjustments in it. So that no one can serve my clients like me. I have a personal relationship with them. I've known these clients for years. Oftentimes they're telling me things they don't tell their spouse. I go to their kids' weddings. You know, I don't think the buyer can keep my clients. And the whole point of that is that I shouldn't therefore accept a retention-based deal, you know, because I won't get paid. First off, the underlying premise of that, I think, is bunk. I mean, I believe that we've been involved in hundreds and hundreds of deals, and clients will transition to a successor in almost every case, other than very unusual circumstances, as long as the proper transition plan is put in place and is given enough time to be executed. But what I always have to tell that seller, of course, is, well, if what you're telling me is true, then your practice has no value, because who's going to pay you for a practice where they can't keep the clients? So rather than take the approach that no one can keep my clients and expect someone to somehow not figure that out and therefore not do a retention-based deal, it'd be better for you to understand how to do it and to put together a business plan that successfully gets your clients to transfer from you to the buyer. So the underlying value is really based on the business plan that backs up the transition. However, the deal terms do have an impact, of course, on the value of the practice. And the deal terms fall into 5 primary factors. The first factor is how much cash is paid up front. Now, we're talking about a sale at this point. We're not talking about a merger. And typically in a 2-stage deal, at the beginning of stage 1, it's very unusual for any money to be paid up front, because keep in mind that we're going to be continuing to pay the seller their compensation during stage 1 at the high level, so there's no return on investment. So at the point in time when we actually get into the selling part, the buying part, you know, what kind of down payment are we talking about? Well, one of the things that will affect that, of course, is the time of year. If you close a deal in December and you're looking forward to, in most practices, a lot of the profit being generated in the next 4 months, you might be more inclined to pay a higher down payment than if you're closed a deal in May after all those profits have been kept by the seller. The cash flow of the deal, I mean, most practices are somewhat seasonal, and how well they cash flow will have an impact on the amount of down payment. And of course, the treatment of accounts receivable could have an impact. One of the things that I hear from sellers oftentimes is, I want to make sure that the buyer has skin in the game, and they define skin in the game as a large down payment. The thing that they're failing to recognize oftentimes is how much skin in the game they've got before the down payment. So for instance, if we're going to allow the seller to keep receivables in WIP, which typically run between 20 and 25% of the volume of the practice, then that 20 to 25% is going to have to be replaced by the buyer. So if it's $1 million practice, right there we're going to be investing somewhere between $200,000 and maybe even $300,000 of cash flow in the first 3 or 4 months of the deal in order to replace those receivables if they've kept the receivables at the outset. It's not unusual to spend another 10% or so on transition costs, and if there's any deal costs, lawyers and consultants and so forth, that can add as well. So it's not unusual before any down payment's made for a buyer to invest somewhere between 30 and even 35% of the volume of the practice. So I call that skin in the game, and oftentimes I have to sort of remind a seller that that's happening. The second feature, of course, is the retention clause, and there's almost always, there's different ways to do this. Everybody's heard of doing a deal at 20% a year for 5 years. That's a collection-based deal, and that's in essence a retention clause. Some deals are fixed. It's very rare that you see that, and typically you're going to see a much lower multiple when that happens. But I haven't actually done one of those, but I know that they have been done. More common would be a limited guarantee, where maybe we have a 5, 6, 7, 10-year payout, but we fix the price after 2 years based on the retention for the first 2 years following the closing. The third factor, of course, is the profitability of the practice. One of the things to keep in mind here is that the seller's current profitability is a guide to how profitable the practice is, but it's not the end. What really is important is the buyer's anticipated profitability. So as an example, if I'm a sole proprietor and I'm working out of my house, I've got a very small practice, and my wife answers the phone, I have no employees, I have very little overhead, I've got maybe an 80% profit margin, and if all of a sudden I change and now I hire an employee, I move into an office, and now I'm incurring a lot of overhead, but my margin's down to say 50 or 40%, at what point in time is that practice more profitable for the buyer? Of course, it makes no difference. I mean, it's the volume of the clients, and they're all the same. So you need to look at not just the seller's historical profitability, but in fact, how's that practice what kind of profitability will it create in the buyer's hands? The tax ramifications of the deal are part of the profitability. Is the deal going to be treated as a goodwill transaction and therefore amortizable over 15 years, or will it be treated as deductible as paid? That can make a big difference in the cash flow to the buyer, of course. The length of the payout period makes a difference. We're seeing longer and longer payout periods, and one of the trends that we're seeing now is in exchange for long payout periods, which it's not unusual now to see 10-year payout periods, is to maybe treat some or all of the deal as a goodwill transaction, because it's no longer, you don't have as much of an imbalance between the payment period, the payment flow, and the tax deductions. So the multiple is the effect of those other 4 payments. The point is here, there's a cause and effect. The lower the down payment, the longer the payout period, the higher the profitability, the longer the retention guarantees, the higher the multiple a buyer should be willing to pay. So, whenever you think about, pushing on one part of the terms, those 4 basic terms, expect some kind of response that might in some other way. So, for instance, I might be willing to treat a deal as a goodwill transaction, but in exchange for that, I might ask for, say, a 15-point reduction in the multiple as a trade-off. So that's an example of a cause and effect. So we go back into this deal, look at Frank's buyout terms. Frank wasn't paid any down payment, even at the beginning of stage 2, and that's not unusual in a 2-stage deal for that to happen. He was paid 16.67% of his collections from his book of business for 3 years. The price locked after 3 years, and whatever the price was based on those first 3 years collection was then paid over the next 3 years. Half the deal was treated as an asset sale and half was treated as a consulting agreement, meaning half would be eligible for capital gain in case it was treated as personal goodwill. Frank was essentially paid 1x on his managed book of business, but I'll tell you the multiples will vary depending on the market and quality considerations, and there's definitely a trend downward in terms of multiples. So it's much more rare now to see a deal at high multiples, which might be as high as, used to be as high as 1.5 times. Those are hard to find now. If you're going to see a multiple, you might see something over 1x, but it depends on the size of the practice. It depends on the market you're in. It depends on how many buyers are available. The more buyers that are going after a practice, obviously, the more they'll probably be willing to pay. In Alice's case, to the partner agreement, was conditionally guaranteed her comp for 2 years at the level of $275,000. And after 2 years, well, during that 2 years, if her comp under the firm's current partner conditions on her compensation required that she maintain her historical level of billable hours and that her book of business was kept at the same volume that it had been. So if there was a drop-off in either one of those, her compensation would be adjusted. She received a pro rata share of equity based on her revenues. In this case, it was 8%. It would have been 8% equity. So we look at her book of business plus the acquired firm's existing book of business, and then that formula creates that percentage. She contributed her AR and WIP as a capital contribution to the new firm, and otherwise became bound by all the other terms of the new firm's agreement. As I mentioned, Dan did not come on as an equity partner. He signed an income partner agreement, and his compensation was pegged at $150,000, which is what he was making prior for 2 years. Again, the same kind of conditional guarantee, although in his case it wasn't conditional because he wasn't an equity partner. And $150,000 was consistent with what income partners in the other firm would make. He was eligible for bonuses like any other income partner. The AR and WIP was put in limbo. If he became an equity partner, then would retroactively become a capital contribution. But if he wasn't within 3 years, then he would have been paid for his share of the AR and WIP, which wasn't significant. And if he was made an equity potentially in some deals, he might also be bought out of his share of the firm's volume, but it's not unusual for that not to happen in these kind of situations. That's usually negotiable. One last polling question, Nikki, before we wrap up.
Okay, this is our fourth and final polling question. This time it is about your firm's most likely succession plan. Does that look like finding an external buyer or having an upstream merger? Will it be an internal solution? You'd prefer not to sell or merge, or you're not sure what your firm should do? I'll leave it open for about 5 more seconds. And it's our final polling question of the day. Okay, everyone has voted, so I'll share the results. Just over half selected that first option of finding an external buyer. 1/3 said they don't know what their firm should do, and that left 13% that indicated an internal solution.
Okay, thanks. So when you're looking at how to find the right successor firm to merge into, think of the 4 C's. And the 4 C's are culture, chemistry, continuity, and capacity. Culture, everybody always says that successful deals are based on like-minded cultures. But then it's difficult to define what that means. I mean, you walk in a place and you can kind of get a feel, the look and feel of it can tell you something. Is it messy? Is it very, does it appear to be, very extravagant? Or is it a formal kind of operation, or is it informal? There's different things like that are important in terms of defining culture. But the things that actually make a deal work or not work can be answered by asking 3 questions. What's it like to be a client in this firm? What's it like to be an employee in this firm? And what's it like to be a partner in this firm? And when you ask those 3 questions, you can break those down into operational components. So for instance, what's it like to be a client in this firm really is how am I going to be served? If I'm used to someone coming to my office every month and doing the work in the office, and all of a sudden the new firm isn't willing to do that, that changes the client experience and is a cultural difference because maybe that firm doesn't feel like they should operate that way, but it affects the client experience. If I'm used to being billed once a year for all my services and the new firm's going to bill me every month on a progress billing, that's going to change the client experience. So looking for differences in the way clients are served, the way the client experience is going to change can be a cultural issue. If I'm used to primarily working with a partner and now I'm going to be working with a senior, that's another example. What's it like to be an employee? What kind of hours am I expected to work? How many hours during tax season? Is this firm now a firm that expects 80 hours a week during tax season, where the firm I came from, kept things down to 50 hours a week? What kind of title am I going to have? What's my workspace going to be like? If I was used to being in a private office and now I'm in a cubicle, that'll change the employee experience. If I'm used to being able to work from home and work mobily, and now I can't do that in the new firm, that changes the employee experience. And then, of course, from a partner perspective, accountability, the comp system, governance, what your role is going to be, are all issues that define the culturally define what it's like to be a partner in that firm. Chemistry, the best way to assess chemistry is a question my partner Joel Sinkin always brings up. If you don't want to have lunch with the person on a regular basis, don't do a deal with them. You got to like each other. You're going to spend more time with people in this firm than you spend with your spouse. So, chemistry is an important aspect. Continuity, we define continuity as things that are going to change that are in front of the door and things that are going to change that are behind the door. The things that are in front of the door are the things that are primarily the clients are going to change from the client's perspective. The things that are behind the door are the things that are going to change from the employees and partners' perspectives. It's not that you shouldn't expect change. I mean, it's great if you didn't, but that's not realistic. It's more an issue of how much the change is going to, how fast the change is going to be introduced and how much it's going to be. So looking at continuity and trying to keep things sailing in the same direction for as long as possible can be an important aspect of success. And then capacity. Does the firm you're merging into have the capacity to take this on, including replacing you? So if you're going to be leaving, go back in 3 years. It would be important for Frank to be comfortable that the firm had the capacity to take over his role within 3 years. When looking how to prepare yourself to be an attractive candidate for the market, you are what you are. However, there's some things you can do to make yourself look better. So one of the things that buyers hate is inheriting problems and practices. Now, of course, I always have to remind a buyer that the reason why this firm is talking to you is because they have an issue they can't solve on their own. They're looking for you to do that. So it's not like that you can expect the perfect deal, but the more problems and more issues the buyer has to inherit, the less attractive the deal becomes. So one of the things to do is to clean up the AR and WIP. I mean, a lot of firms don't like writing off AR. Well, if you're sitting there with AR that's 3 years old and you know you're never going to collect it, get it off the aging. Don't give that aging to the buyer. Present your partners and staff in a very positive light. The talent and the people issues related to most deals are becoming more and more important in deals. So people don't want to hear that so-and-so is a problem. If you have a problem, get rid of the staff ahead of time. Clean up the office, provide good time records. That's another issue we run into, particularly with smaller firms. And be willing to part with unprofitable clients. So you got clients that you should get rid of. If you either get rid of them beforehand or indicate as you're in the discussions, we understand we may have to get rid of some of these clients. Should you ask for as much money up front as possible? In other words, the down payment. Well, first off, most buyers, whatever you're asking for up front is creating a further investment on the part of the buyer. Many accounting firms don't like to borrow money, and many firms try to finance deals, without doing that or by limiting the amount of borrowing. The more money you're asking for up front, the more pressure you're putting on financially on the deal. And what are you accomplishing anyway? So if I have a deal where I'm going to get paid 1x over 5 years, and I'm pushing hard to get a 40% down payment instead of a 20% down payment, how is that going to affect how much money I'm going to get in the long run? It's not going to affect it at all. But what it might affect is the buyer's, first off, willingness to do the deal, or how much they're willing to pay me in terms of a multiple. Maybe they say, look, sure, I'll give you 40% up front, but I'm not giving you 1x. Maybe I'll just do a 0.9 or a 0.85 as a result. So in essence, you cost yourself money by pushing on that. And using your accounts receivable as an offset. Sometimes you can, if you're willing to let the buyer keep the receivables and work off those receivables for a period of time. I'm not saying give them to them, but get paid over time on those receivables. It's going to take some pressure off the deal, and they might be more willing to increase a down payment or do something else with the transaction to make it more profitable for you in the long run. Should you shorten the retention period? Is 1 year retention better or not? Actually not. When you think about it, if a client's going to stay, we're going to know after the first year whether or not they're going to stay. Well, buyers aren't stupid. They know that. So knowing that the worst thing that could happen is have a client stay 1 year and then leave, buyers tend to shake the tree hard, make sure that they know that a client is, if any clients that are uncertain about whether or not they're going to stay, don't stay, and as a result can actually push the retention down by having too short of a retention period. So we recommend that retention periods typically be at least 2 years long. You can also use limited retention periods, which is something less than the full payout period, or negotiate the ability to replace lost clients with new clients instead of getting a new business bonus. For more information about issues related to succession planning, we help the AICPA with their Succession Planning Resource Center. You can see the link here. I highly recommend that you look at it. There's a lot of tools on there. They're not all ours. That'll help you work through succession issues in your firm. As I mentioned, we do a webinar all the time, and you can download many of those from our website. You won't get CPE credit if you do, but you can view the webinars on our website. These are 5 of the more recent ones that we've done this year. You also can find articles that we've written, not only for the Journal of Accountancy, although we have written, I think, 25 articles for the Journal of Accountancy, so many of them are from there. One of those was a series of 12 months in a row. The Succession series we wrote from July of 2013 to June of 2014 that cover almost anything having to do with succession and mergers and acquisitions. And that was followed up with a series of 3 articles later that year that were strictly on the issue of valuing an accounting firm, both for large firms, small firms, and internally. And then last September, another article on roadblocks to avoid in M&A of accounting firms. I'm a member of the CPA Consultants Alliance. You can see the other members listed here. This alliance was formed to provide educational materials to the accounting profession. We recently published a book that you can buy on Amazon, which is called Bridging the Gap, Strengthening the Connection Between Current and Emerging Leaders in the CPA Profession. That's been pretty well received by the profession. We've also issued 3 white papers that you can download at our website, and you can also sign up on our website to receive ongoing information that we publish almost weekly. These are the 3 white papers that we published over the last 3 years. If you have any questions at all, again, or want to access the information that's on our website, there's a tremendous amount there. Feel free to do so. Again, if you have any questions for me, please send them to me. And I see we do have one here. Was that just the only one, Nikki? This one on
yes,
Alice's AR?
That's right, just the one question.
What Alice did was, and there's some tax consequences to this that I don't have the time to get into right now. Just think about Alice. If Alice had 25% of $800,000 of capital in the firm, which was made up of AR and WIP. She was required to make a capital contribution to the firm so that the firm could have some capital to work off of. And in essence, she donated her AR and WIP. Now, I realize that creates some tax consequences, and there's other ways to deal with that as simple as what I just described to avoid those negative tax consequences. But that's conceptually, that's in essence what Alice did was she contributed her $200,000 of AR and WIP as a capital contribution to the firm, so that the firm, all partners are required to maintain capital in the firm. And I think that's it. Thank you for your attention today.
Great. Thanks so much, Terry. Just a reminder, there will be a survey that will pop up in your screen as soon as we end here, so take a moment to do that before you close the browser. You'll also receive an email in about an hour that will include links to those articles that Terry mentioned. If you reply to that email, it goes directly to me, so I'm happy to answer any questions about CPE. And if you have any questions that you'd like to address with Terry, you can always use that email address that's on the screen. So thank you again for attending, and have a great day.